Hello and welcome to a stock analysis blitz for Persimmon. Persimmon are a FTSE 100 listed home builder currently paying a 5.7% dividend yield. Thanks to Carl J for suggesting I take a look at Persimmon. Before I start, please remember that I only do these videos for fun as a hobby and always speak to a qualified financial professional before making any investment decisions. So Persimmon have a nice and simple business model. They buy up a continual inventory of land, build houses, and then sell those houses. And of course, we're all fairly familiar with new builds. I think most people have gone and visited a show home just out of interest as much as anything else. I actually really like the business model. They have their really fancy brochures where you see the plan for the new community. They give you these glossy handouts for each house, and they all look very impressive. Now, I do know some people who've bought higher end new builds, which are actually very impressive houses, but for most people in the 200 to 300k range, when you get inside, they put in lots of en suites and things and extra bedrooms to try and make it all very luxurious. But the reality is, it's all a bit cozy in there. And although the houses look impressive in the brochure, give it a few years for them to weather a bit, and they start to look like glorified ex-council houses, particularly at the price range that most people are talking about. Still, I think that it's an amazing business model. And one thing that Persimmon do is they actually manufacture their own bricks and make their own tiles, as well as making the timber framing. So by making all of these construction materials, they then increase the profits they make when they sell the house. And another thing that I thought was amusing is they have their own fiber nest company. So they actually have their own internet company so that they can say to customers when they're hesitating whether or not to sign the contract with them, that when you buy a house with Persimmon through their fiber nest, you'll have the internet from day one of moving into the house. I thought that was quite amusing as a nice little sales tactic. So they have three different groups really of Westbury Partnerships, which is 10% of their sales. And this is essentially social housing. And then they have Charles Church, which is the posh houses. But actually, the mainstay, 80% of their revenues is from Persimmon Homes. And these are the kind of estates that most people will be familiar with. Now, of course, very relevant to Persimmon is house prices and the house market. And my favourite website for studying this is housepricecrash.co.uk. If we look at house prices adjusted for inflation, we see that we are currently in a bit of a correction here, or in fact, you could say there is a crash started, adjusted for inflation. But also, we're quite quickly departing from this long term trend of the increase in house prices adjusted for inflation. And so things might not get as severe as you might worry, certainly when you look at, certainly when you consider that graph. But of course, when you look at nominal house prices, they haven't crashed. They haven't crashed yet, and in fact, they're looking very robust. So, although maybe there's a start of it here, the reality is we haven't really seen a house price crash yet. They're looking very, very robust at the moment. But of course, everyone at the moment is screaming that we're in a house price crash. And strangely, it only really started quite immediately in the last month when interest rates went up to 5%. But currently, everyone is talking about we're in a house price crash. But the fact is, the data isn't showing that. But this could actually perhaps make Persimmon a counterintuitive play. So going through their history, in 2019, they had to replace their CEO, and then the CFO retired in 2021. So half the time, that's obviously a bad sign. They had the COVID crisis crash, but then in their trading update of 2020, their results were still amazing. So the share price was fairly steady until 2021, when it began its rapid decline, and the share price has dropped by 2/3. That's quite a huge drop, and this was in line with the interest rate increases. Now, of course, your typical customer who goes in buying a new build, they're relying on a mortgage to do that. So that does kind of make sense. But actually, right up till 2022, their results have been extremely good, as you can see here. So very good results, including up to 2022. But then they had a trading update only the other week. And in this trading update, they announced that they expect completions to be down 40% based on the Q1 data, with a 42% drop of completions in the Q1 2023 based on what it was a year ago, and a 30% drop in sales positions. And they said that they've seen lower sales rates and elevated cancellation rates. And presumably this is all in response to these increasing interest rates. They have actually been responding to this, and they've deliberately reduced the number of houses they're building by 30%. But all the same, the Q1 2023 results are a serious downgrade. So it is fascinating that just how the stock market is supposed to do, the share price actually fell as analysts, I guess, priced in these increases of interest rates well ahead of actually when we actually start to see the results of that in the Q1 2023. So that's interesting, seeing markets behave how they're supposed to behave, which is actually fairly unusual these days, it seems. Something else in their recent history that I'll mention is the cladding issues. So in 2021, they announced 75 million of provisions related to Grenfell style cladding that they had legally put into their buildings. Despite the 75 million of provisions, they pretty much say that according to the contracts, once they've sold those buildings, they're not responsible for any cladding or anything they've put on it, as long as it was done legally. So my interpretation of that is they're kind of saying, not really our financial problem. But then interestingly, they announced that it's now, that provision's gone up from 75 million to now 350 million, and they are now going to pay for replacement of this cladding that they built when they built the houses, even though they earlier said they weren't responsible because they'd sold the houses already. Actually, in this RNS, it says that this was their intent. It says that this was their intention all along, but I do find that a bit interesting. How come the provision goes up from 75 million to 350 million? So I'll leave you to draw your own conclusions. What happened? All in all, this 350 million provision, if it wasn't for that, this dot here is what their net income would have been in full year 2022. As you can see, it's a very, very good financial result, very, very good financial performance going up to the full year 2022. We see here actually the drop though in completions, how sharply that's fallen as we move into 2023. I based that on their latest trading update. So looking at their numbers, one thing I'll mention is that for their assets, they have this heinously complex company structure, which means they have to report company and then group assets. A lot of things that should be long-term assets, like land holdings, actually appear as short-term assets in their books, but that's because I'm using their group numbers, because that's more useful for understanding where everything's sitting than the company groups, where all of those assets get packaged into the subsidiaries on a long-term basis. But bear that in mind. But still, going on looking first of all at their income and expenditure, and we see they brought in a very steady revenue of about 4 billion every year the last 5 years, and their costs are fairly steady, but we do see actually a increase in their cost of sales, which is presumably workers' wages going up and the cost of bricks and mortar going up due to inflation. But overall, they did achieve over the last 5 years a steady 0.8 billion of net income, particularly if you take account for the replacement of the Glenfield style cladding from the houses they built. So a very solid performance, really. Bear in mind they were paying really good dividends in that time. Now, interestingly, if we look at their sales back in 2010, then they were only making 70 million a year net income, whereas now that is effectively about 800 million a year in 2022. This blue flag here represents 2010, when they just about got out of the previous house price crash. And bear in mind that their sales have actually 10x'd from then, from 70 million to about 800 million. And yet their share price had only really 6x'd. So that's just an interesting relative measure there. Most of their income is simply selling the houses. They actually, people actually part exchange their houses for a new build, and that provides only 3% of their revenue. The internet isn't even 1% of their revenue. Their FibreNest internet company isn't even 1% of their revenue. So really, it's just all about selling new builds, as I guess you'd expect. When we look at their expenditure, then obviously we see this Glenfield style cladding popping in. Looking at their assets, and surprisingly, obviously because of their strange company structure, most of their assets are actually current assets. When I look at the group data, in the long term, really the only significant thing there is the property, plant and equipment, which is obviously their building equipment, their diggers and things, and intangible assets. But really the long term is a minority. It's mostly current assets, and most of that is, in fact, 2 billion of that is the land inventory they hold to build new houses on, and a billion of that are the houses they've built but they're yet to sell. It's notable that the trade receivables have bipped up, and also the amount of cash seems to be falling. So those are perhaps signals that they're starting to run into problems. But generally, a very straightforward presentation, and their assets are real things, which I like. With their liabilities, the long-term liabilities are very minimal, and they've got no debt at all. And of course, we love companies that don't have any debt. So most of their liabilities are actually short-term liabilities, particularly trade payables. So they have a very impressive net asset composition in my regard. Solid assets. My only comment really would be, if house prices start to drop, then they'll have to start taking write-downs on these assets. They seem to generally have achieved sales growth of about 10% every year. And then, of course, we had this big hiccup because of the COVID. But other than that, about 10% a year. Of course, we know from their Q1 2023 data, though, that could be that they could be seeing a serious reduction in growth moving forward in the next few years. So looking at their market cap, it currently stands at about 3 billion. And in terms of their net assets, we're looking at a price to book of about 1 at the moment. Their price of earnings is 6. Now, this was all very good in 2022 terms, but what about moving forward? They obviously look like a bargain in 2022 terms. Well, now this is only a stock analysis BLITZ video, but I've done a very quick and dirty forward income calculation of my own. Of course, always speak to a financial advisor before making any investment decisions. Don't go on my rogue calculations here, but what I've done is I've assumed a best case of house prices going up 5% every year, and a worst case of house prices going down 10% every year for the next 5 years. Now, that is actually a very doomsday scenario calculation, I should say. And I've assumed that in my worst case here, completions go down 10% a year and building materials go up in price 10% a year. So that is actually a very extreme worst case, I think. I've took account of a 40% drop in completions, and so this starting point for this year is based on their Q1 2023 data. And so from there, I've put together a mid case and a worst case. And so from here, if the mid case, when we add their cash coming in the next 5 years on top of their net assets, they actually look quite well valued now. With my worst case, they look, you could say, fairly valued now. So, but then what about the drop in assets? Well, let's say their assets drop in value by half, and that's like a 2 billion, a very approximate here, but a doomsday house price situation. I've calculated about a 2 billion drop in the worth of their assets. So then they would kind of look slightly overpriced now, but not way off. So again, consult your financial advisor. But my rogue calculations here, um, they're kind of very interestingly valued at the moment, and I'd kind of almost say that the markets are kind of fairly valuing them at the moment. Now, please bear in mind though that because this is only a stock analysis blitz, I didn't spend too long doing these rough calculations. It's just to give me a first glance. But I need to spend a lot more time double checking all that. But they definitely do go on my watch list. And I don't think you have to try and time the bottom here. When we look at what happened in the 2009 house price crisis, there was quite a period of consolidation here. So you had plenty of time to absorb the real-time data and then get in there for what was an amazing run. So Persimmon definitely go on my watch list, and I want to spend a bit more time studying their data a bit more and modeling how I think they should be valued beyond this initial first glance. So to summarize, Persimmon definitely get onto my watch list. I'd like to wait out their half year data and their data throughout 2023 actually. This will help me model them a bit better, and then as I see how that data is impacted by things like house prices, I also want to wait for a better idea of the house price scenarios because that's still in a state of play. But I think they're a very good opportunity for the future, but there's no need to try and time the bottom. A bit of patience and some good hard work could make these a good investment opportunity at some point in the future. So that completes my stock analysis blitz for Persimmon. I hope you got some use out of this video, and play safe. Please read the disclaimer. Remember that prices can go down as well as up.